Hello there. So, this little rant is about a kind of investment that made Warren Buffett one of the richest men in the world, and for a time, the richest man in the world. Now, if you look at the richest men in the world, at least American ones, they have made their fortune from building companies which are growth, momentum technology businesses. They invent something and then they run that business for a decade, 2 decades, and they become billionaires because those businesses become so massive that their shareholdings are worth billions. So you're looking at the Google guys, you're looking at Elon Musk, you're looking at Larry Ellison, you're looking at the people at Apple, Steve Jobs, etc. Those guys are not the sort of investors that we can be. But then if you look at Warren Buffett, he's done none of that. He's a runner of businesses, although they don't make a fuss about that. He runs a conglomerate, and he's known as the greatest investor of all time, pretty much, on the basis of value investing. Now, there's plenty of books on value investing, but you can really boil it down a lot so that the novice can understand what's going on. Now, the basics are there are great businesses out there, and nobody really takes a huge amount of notice of them. They don't treat a really good long-established business, even the biggest and the most mightiest like Walmart, anywhere like Nvidia or Tesla. So basically, you get more profits per year, per share, from a Walmart than you do in Nvidia. Now, the reason people buy Nvidia is that the share price is going to go to the moon. So when they buy it at $10 a share, they're hoping in 10 years it's going to be $1,000 a share. And occasionally that proves to be correct. Now, obviously you can see that with Nvidia. You can see that with Apple over the last 25 years. You can see that with a number of technology companies. They come out at a good valuation, but they just keep getting bigger and bigger. Microsoft, Amazon, Google, the FANGs. They start out expensive and they grow really fast, which is why they're expensive. And they keep growing really fast, which is why they stay expensive. And then even when they're massively expensive and they have a massive market cap, somehow they carry on growing incredibly and they get even more incredibly valuable. So once upon a time, incredibly valuable used to be 200 billion. Now it's 3 trillion. In 25 years, you've seen those valuations go up from 200 or 300 billion max to 2 or 3 trillion max. So that's a 10x. But that's not what made Warren Buffett one of the top richest men in the world. What made him rich is value investing. Now, he was a student of Benjamin Graham, and in fact worked for him later on. And Benjamin Graham wrote a definitive book on the subject called The Intelligent Investor. But if you didn't want to read 300 pages, which most people don't, even though they really should, and keep on reading those 300 pages over and over again, the principle is really simple. What is a cheap stock? Now, Wall Street wants to tell you a cheap stock can get cheaper. And, if you want to stay poor, just buy cheap stocks and you'll stay poor. However, that's not Warren Buffett's record. So what is the simplest way of thinking about value investing? First of all, you've got to pick a good company, a good solid company with a good solid business. You can decide what that is for yourself. Then you're looking for cheap. Now, cheap basically comes down to what does the company cost in terms of its profits. There's a very simple measure for that, and it's called the PE ratio. And grossly, you can consider that as how many years of profits does it take to buy the business. Now, if you're looking at the darlings of the NASDAQ, some of these companies don't even have profits. But if you look to the ones that do have profits, you'll be seeing PEs of 30, 40, 50, 60, 200 times, which means that a business with, say, 60 PE, if you collected up all their profits over roughly 60 years, you would have the market cap of that company. Now, down at the value end, you'd be looking at 8 or 9. So you can buy that business for 8 or 9 times its yearly profits. Well, when you start to think about it, let's just say you've got a 10 PE. Well, if you could borrow the money at, say, 3%, and you had to pay it back in 20 years, you could easily pay back what you would borrow, including interest, by simply finding a way to borrow that money to buy the business and use the profits to pay back the bank. And that is effectively what private equity does. They borrow money or they get it off of investors, they buy a cheap business, and then they run that business and pay off those debts and pay out their investors from those cheap profits. Now, of course, they would say they do clever things like making the business better and breaking the business up into pieces and selling them off. But basically, they're buying cheap profits with borrowed money, and they're paying off the debt that they created to borrow that money from profits or from sales of assets which are undervalued. But you don't have to get complicated. Good business, low PE. That's a very good starting point. Now, once you've found a load of really good businesses with low PEs, and they are out there, sometimes there's not so many of them, other times there's plenty. Once you've found those businesses, you might want to look at some other things, like how sustainable are those dividends they're paying? Dividends. You're an American investor. Dividends, you don't often see them now, do you? But companies that pay dividends are also a very good place to look. So low PE, dividends. Very nice. Then something I look at, which is pretty controversial, funnily enough, and I don't see why it is controversial, is how much are they selling? Are they selling a lot of stuff? They are. You know, it's quite difficult, as any business person will tell you, to sell a lot of stuff. And whatever anybody says about companies that don't sell very much but somehow are magically valuable, selling stuff is tough. So if you're selling stuff and making a nice profit and paying out a nice dividend, that's a very good sign. That probably means you're a good business. And if you've been doing it for a long time, it's pretty certain that you're a good business. Now, imagine that you're in an industry that everybody hates. They say, oh, there's no future to it. Imagine newspapers, for example. I mean, you can find newspaper businesses in Europe which are dirt cheap. And they've been dirt cheap for a long time. And they've been going out of business for a long time because of the internet. But they haven't gone out of business. And they're still paying fat dividends. And they still sell a lot of newspapers. And nobody wants to buy their stock. So that's an example of a value investment. And in those 5 years, they might have repaid you a third of your investment in dividends alone. Now, I'm not saying that newspapers are a great value investment right now, or will ever be. But it's funny how those industries quite often don't go out of business. And in fact, their profits don't fall, and they carry on grinding along, making good profits. Now, Benjamin Graham, who kind of invented this category, and which Warren Buffett followed, he used to liken a value investment to a cigar that had been smoking down to a butt. You can still, like any hobo, get a few puffs of that cigar before it really is dead and gone. And that was his premise. He studied it, refined it, back in the, I think it was 40s and 50s, and turned it into an investment style. But that investment style still continues today. Low PE, probably a good dividend, lots of sales for a business its size, and a good solid track record of being in business. And you can get a lot more complicated than that if you want to. But low PE, solid dividend, good business is a great place to start. And you can build up a nice wide portfolio of those sorts of shares. And on average, they will give you a very, very solid return year in, year out, which is what Warren Buffett does. And if you want to find value investments, you don't actually have to go and dig around in all that information online. You can actually see what he's bought. You can actually see what he's held. And you could just mirror his portfolio. You could do a lot worse than that for sure. But you will notice that he buys into very large, very solid, very consistent, not very expensive stocks. That's his MO. And over the many, many years, he's very rarely diverted from that. And actually have written a book on value investing. It's a long, long time ago, and it breaks a lot of other different things down so you can cover all the bases. But really the fundamentals are low PE, nice dividend, big business, long established. You won't go far wrong putting your money there. I hope that's given you a little insight into value investing, which is a place where if you're beginning your investment journey, is a good place to start. Because unlike all the fancy stocks, and unlike all the stocks you'll read about in the headlines and around the internet, it's an area which has been neglected. And it's been neglected since the beginning of time. Because one of the reasons why value investing is so remunerative is that very few people want to do it. And very few people want to own really, really boring shares that are kind of okay, that nobody would ever talk about in a bar, that is never on CNBC as a headline. Because the market pays you in the coin that you want to be paid in. If you want to be paid in excitement, it'll pay you in excitement. But it won't pay you as much in money because you're getting your benefit in excitement, and so is everybody else. It won't pay you as much money if you invest in a stock that makes you feel good or gives you status or gives you entertainment, because you're getting paid in those things, not in cash. When you start to invest in companies that basically have to get down on their knees to beg you to buy their shares because they're so boring, then you're going to get paid in cash, and you're going to get paid well. That is the trick to value investing. Anyway, I hope you enjoyed this little rant. Thank you very much for watching and listening. I'll be back soon. Bye now.